following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we have the answer about money. That's what's going on today. I mean, after a rocky, rough week, we saw ups, we saw downs. We have a volatility that's going to continue to plague us probably for the first 6 to 8 months of this year. It's going to take a while to get back to full and open economy, so we're going to see this kind of bouncing back and forth. But the two big announcements this week, this first week of March, were not related necessarily to the market, but they were related to the industry. Senator Warren, Elizabeth Warren, announced, along with several co-sponsors, a proposal to tax the ultra-wealthy. She proposed 2% of assets for those who have $50 million or more worth of assets, net worth, and an additional 1% if their net worth is over $1 billion. The claim is that will raise $3 trillion over 10 years. And what's happening is it's a very popular kind of thing with the public, very, very, very unpopular with billionaires. That was the first announcement. The second announcement is that Wal-Mart announced they are entering the financial services market. Amazon is already there. But Wal-Mart lured away 2 senior bankers from Goldman Sachs. They have a partner. They signed a deal with a partner who's already set up some online banks. And it's not really clear what part of financial services they're going to be looking for. But the claim is that it's requested, and banks are pushing back hard on it. Those, for me, were the big stories of the week concerning the financial markets, and we're going to get to those. And I want to start with the Elizabeth Warren and the tax on the ultra-wealthy. Now, let me give you a little background for what's going on. I've talked about this before, but I want to revisit it again. There's 4 big issues that are facing this new administration. Healthcare. You know, we've just gone through the pandemic. We're still at the end of the pandemic, hopefully at the end of the pandemic. And there's been a number of things going on with healthcare. Plus, the Affordable Care Act was really hurt during the past administration. We'll see a lot of that restored with executive orders. Executive orders took away some of the rights of the Affordable Act. We'll see some of that come back with the Biden administration, and we'll probably see improvements to it. But that's a major issue. Second issue is climate change. And that may be the number 1 issue for the Biden administration. The other 2 issues are lifestyle changes and income inequality. And it's that last one that the wealth tax is targeting. They're looking at child care, which is also partly lifestyle changes, but early education and funding K-12 schools, funding some infrastructure and more. But to understand all of this, we have to go back to 1971. 1971. Prior to 1971, the U.S. economy was chugging along at a pretty good rate, and there was a fundamental shift that took place in 1971. We'll talk about that. But up until 1971, wages were rising pretty steadily through the 1950s and the 1960s, but they began to flatten in real terms after 1973. From 1947 to 1973, income at all levels, for the top 1%, the bottom 10%, pretty well were increasing at the same rate. But in 1973, that changed. The top 5% continued to increase, but the bottom 95%, adjusted for inflation, flatlined, and it's continued to flatline through 2020. Now, the top 1% make close to 25% of all income. If it was evenly distributed, the top 1% would make 1% of the income, but they make up 25% of the income. And in 1973, it was only 9%. Now, of course, we know that the top 1% are going to make more than the bottom 1% or the bottom 10%. But in 1973, it was 9%. Now it's 25%. If you look at what happened, productivity per capita, the amount of product produced per hour of work, from 1948 to 2017, productivity increased 248%, which meant for every dollar paid for labor, you produced $2.48 worth increased per dollar of dollars spent for income. But income only increased 115%. If you look at that period of time, from 1948 to 1917, GDP increased 325%. But for the median wage earner, essentially, earnings were flat. Taking just the period of time, 1980 to 2018, and if you're not keeping up with the math, I'm sorry about that, but I'm a mathematician. I like the math, so stay with me on this. 1980 to 2018, GDP rose 79%. So you'd expect wages to rise 79%. But if you look at the bottom half of the wages, they were up only 20%, and that's not adjusted for inflation. GDP up 79%, bottom half of workers up only 20%. If you look at the middle-income workers, GDP was up 79%, middle-income workers up 50%. But if you look at the very wealthy, they were up 420%. GDP up 79%. So you can see what was going on with income inequality. That's the background for this whole thing. And yeah, there were reasons for it. The income inequality began to separate in 1971, but that wasn't it. That wasn't all of it. Budget deficits increased, trade balances increased, savings rates tumbled. The share of 25 to 29-year-olds living with their parents tripled. The median marriage age increased from 21 for females and 23 for males to 28 and 30. The percent of children born to unmarried mothers skyrocketed. Childhood obesity quadrupled for over 20% of the population. Those were all significant things. Health expenditures per capita skyrocketed 15 to 20-fold. So those were large and enduring changes. So how do you address that? Part of that is this whole concept of an ultra-wealth tax, or a tax on the ultra-wealthy. That's the conversation. That was the bill proposed, and it's extremely controversial, as you would expect. And the negative, the pushback, people are saying there's a 50-50 split in the Senate. It will take 60 Senate votes to pass. So you don't have to worry too much about that happening. They say, secondly, the ultra-high net worth people have very complex estates. Sometimes it takes years to sort out the net worth of the ultra-high net worth people. They're tied up in businesses, they're tied up in properties, they're tied up in trust, and the assets are held around the world. Sometimes it's even difficult to locate the assets. Some even disappear. Not from the holders and the owners, but from the sight of the taxing regulators. The largest states that have gone through tax audits, sometimes it ends up in years in litigation. Leon Cooperman, a hedge fund manager, said it's going to be very difficult for the U.S. government and the IRS to find all the assets, because the people with ultra high net worth assets are going to hide those. They're going to find ways to hide it. They already hide a lot of what they have now. They're going to find even more. And some will even renounce their American citizenship. And he questions whether it's constitutional. So that is all going on and pushing back against this tax. But my opinion is, don't underestimate Elizabeth Warren. She's extremely intelligent. She's proven to be highly capable. It was Elizabeth Warren who put together the concept of the Consumer Protection Agency. And getting something huge like that passed through Congress, passed and signed off by the president, getting something set up like the Consumer Protection Agency is a major, major undertaking. And Elizabeth Warren got it done. That's been taken apart pretty well in the last administration. It will be back in this administration. But remember some of the positive things that went on with the Consumer Protection Agency. That's what Elizabeth Warren did. I think you can't underestimate her. We're going to come back and talk about what her proposal is right after this commercial break. So stay with me. You also want to hear about this Wal-Mart proposal and what it means for financial markets. I think it has a significant impact on markets. So don't go away, and I've got a great guest today. Stay with me. Bye.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the tax that Elizabeth Warren has proposed, the pushback against it, the background, why it came up. I said that it's something that you don't want to underestimate. She's done a lot in her career. I don't know if it will pass or not pass, but it's a very significant proposal coming forward. It's been done in other countries, and it was not so successful in other countries, and that's another reason why people say that it may not work. But what she has proposed is that there would be a 2% tax on assets for people who had a net worth of $50 million or more, and an additional 1% on billionaires. That, she estimates, or has been estimated, to raise $3 trillion over the next 10 years. And there's some issues with that. There's some issues because it's been tried in 11 other countries, and most of those found it was unsuccessful. Most of those countries were in the European Union. They found it was unsuccessful because it was easy for a citizen of France to change his citizenship to Germany or to England. A citizen of Italy changed to France, or from Spain to one of the other EU countries. So one, you had people changing their citizenship. The Warren bill deals with that, because if an American citizen changed his residence, there'd be a 40% exit tax on all the assets above $50 million. So if someone was worth $1 billion, there would be a $400 million exit tax. So that deals with one of the issues. The second issue is that those billionaires and high ultra net worth persons who were subject to that tax would find ways to hide their assets. They would find it in move assets offshore, move it to the Cayman Islands or the Isle of Man or to Malta or to some of the other places where you can really hide the funds. A lot of that's gone away because of 9/11. There's been a disclosure of a lot of unnamed accounts of assets that have been hidden. There's been a lot of cooperation in governments to deal with the laundering of money And that figures into this as well. It's going to be more difficult to hide. But in addition, part of the money that the bill would raise, $100 billion, would go to rebuild and strengthen the Internal Revenue Service. During the past administration, the Internal Revenue Service has lost personnel. It's been slowed down in what they do. The number of audits has crept downward. So the idea is to put $100 billion into hiring people, training people, strengthening the IRS, modernizing their systems, because their systems are old. We need to modernize those. To also find people that can find new ways to value assets, new asset valuation methods, because a lot of assets that are owned by the ultra wealthy and the billionaires are assets that are very difficult to value. We see that in all the questions that are raised with the Trump taxes and the Trump reporting one set of numbers for taxes, another set of numbers for insurance and the banks and so on. Some of that, by the way, is very valid and very legal to do. I'm not saying it's an issue. We'll leave that to New York and to the federal government to determine if it was done legally or not, but a lot of that can be done legally. But what the Warren plan calls for is new ways to value assets, make them considerable, and find those things, and to increase the enforcement requirements. The idea is that there would be a 30% minimum audit rate. That means once every 3 years for those people who fall into the category of 50 million and above and into the billionaire category. All of those are to focus on what the taxes are that are paid. And remember this, when you look at it, when you look at the taxes that were paid in 2018, one of the big issues that has been raised over this whole thing is that the tax code of 2017, or the tax break of 2017, truly benefited the ultra-wealthy more than it benefited the rest of us. And if you look at the taxes paid in 2018, billionaires paid an average rate of 23%. The average for all Americans was 28%. So billionaires paid 5% less percentage-wise than did all Americans. If you look at even the bottom 50% of Americans, the bottom 50% in earnings paid 24.2%. Billionaires paid 23%. That's a significant issue. While they can afford to pay a lot more money to hide wealth and to find ways to reduce their taxes, the question is it fair, and is it fair to the economy, and shouldn't they pay their fair share? We have a graduated income tax. The concept is the more you earn, the higher the rate of tax you should pay. What we're finding is that those people that are in the billionaire class will pay less than those average Americans are paying. And that's the warm point. I understand that. Estates may be complicated, but I believe that the onus is going to be on those who have, those billionaires and those who have wealth above $50 million to show what their assets are. And there will be, during audits, questions raised about the valuation of audits. It's not going to be an easy process, and as it normally is with most very complicated estates, a lot of this is going to end up in the courts. Just going to happen because there's going to be disagreements over what things are valued at and where things are. But a lot of hidden assets are going to suddenly show up. And it's also going to mean one other thing. I think it means a lot more assets may be moved into things that are very visible, like the stock market. There's going to be fewer assets where it is aimed at the hiding things through tax-advantaged investments or tax-free investments or gaining those tax benefits, which are mainly sold on the basis of reducing taxes rather than on producing good for the economy. There's going to be a lot of that, I think, that shifts over. I think a lot of that's covered in the Warren bill, and it could very well be a bill which supports some of the infrastructure. Infrastructure is coming as well. $3 trillion is enough to pay for all of that, to pay some for the infrastructure, to pay child care, to pay for K-12, and to increase the IRS. You know, we'll see. It's a very big issue. I just don't think it's going to go away. I just don't think that people are going to walk away from it. And because it's a financial issue, I think there's a way that the Congress will find a way to move it through reconciliation rather than moving it through a 60 vote plus in Congress. And maybe it's one of those things that will lead to doing away with the filibuster too. Who knows? I think it's, in my opinion, it's a positive for you and me as well. So with that, I want to finish that off. The next big issue that I want to talk about is the Wal-Mart announcement, but that's going to have to wait. Stay with me for that. But first, I want to introduce my guest today, Peter Greaves of Peter Greaves Architect. Welcome to the program, Peter.
Hey, Mike. Thank you very much.
Good to have you here.
Thanks for having me on.
Peter, why don't we start with your background?
Sure. How far back do you want to go? I'm a graduate of Syracuse University. I moved out here right after graduation in 1977. I worked for a variety of firms in Seattle, culminating in forming my own firm with a number of partners in about 1984. I got at a certain point, I closed my office and went to work for a couple of firms where I served as principal. And in the wake of the economic meltdown, I left a larger firm and became a sole practitioner, and that's where I am now.
Okay. So tell us about what you do.
My current practice is focused primarily on single-family custom homes, and as we've talked about before, Mike, I'm interested in urban houses and doing as much, we call it a whole house renovation, but in terms of sustainable design, my particular focus is that, there's nothing more sustainable than reusing the existing structure as much as we can. There's a lot of embedded energy in these, 30, 40, 50-year-old houses, and it's interesting to bring them into a kind of current state in terms of energy efficiency and usefulness for growing families.
Great. So we are coming to a commercial break. So, Peter, stay with me. Listeners, please stay with me. We've got a lot more to talk about, especially during this time of a housing market and what's going on in Seattle with new people moving in, with things going on. So stay with me. I want to come back to what's going on with Wal-Mart later on, too. So don't go away. Stay with me. We're coming to a commercial break, and we'll be right back after the break.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I'm here with Peter Greaves of Peter Greaves Architect, and we started talking about his architectural firm and what they do. So you mentioned that you're doing whole house remodel. What's a whole house remodel? Take us through that.
Yeah, so basically, we're trying to take advantage of the existing footprint of the house and rearrange it so that it suits a more modern family. A lot of the things I'm working on are, run from kind of late 1930s housing stock in Seattle to a lot of post-war stuff. And at that time, the bedrooms were smaller, the kitchens were smaller, certainly living room spaces weren't as large as what people want right now. But at the same time, I believe that there's a great benefit in reusing as much of the structure as we can, certainly trying to preserve and reinforce the existing foundation and going up from there keeps a lot of material out of the landfill and allows us to build more efficiently. I think that, earlier houses were more discrete rooms. I think people are much more interested in having, a kitchen that's open to the dining room. Maybe the dining room flows into the living room. So there's a lot of that can be done even within the existing footprint of the house. So that's been my focus.
So I grew up in a house that was built World War II, the return of the GIs. The house was like 860 square feet on a lot.
Yeah.
So, it was a 1945 or 1946 house. So if you were to take that as an example, what would you do to change that?
So typically, what we're doing right now, and I'm actually sitting in my house looking across the street at a neighbor's house that I designed that's under construction. We take advantage of the existing footprint, so the size of the perimeter of the house. The existing house, might have had a 7-foot or 7-foot 2-inch basement height, and now they want to use it as living space. So we pick up the height of the foundation and raise that so I can have an 8-foot floor down there. Then we use the existing footprint of the first floor, but we give it a little more generous ceiling height and then add a second floor on top of that. So it's the same, I don't know what the house across the street was, around 1,200 feet, 1,300 foot footprint. But it's become a 3-story house instead of a single-story house with a daylight basement. My own house, like yours, Mike, was, I'm in a 1935 Cape Cod, so we're in 1,300 feet. We have remodeled within the existing shell of our house, but most families right now want something that's closer to 3,000 foot or so to raise a family. Somehow we managed to all grow up in 8 by 10 foot bedrooms, but people don't really want that anymore.
And sometimes sharing them to a bedroom in those tiny.
Oh yeah, I hear you. Yeah. We had 5 kids in a 3-bedroom house, so.
Yeah.
Yeah.
No, I mean, affluence has taken place, and people can afford much bigger. So all the better for them. So
yeah, and I think a lot of it's pushed by the valuation of current housing stock in Seattle. And even an unrenovated house is just worth certainly 10 times what it was worth 30 years ago.
And it also yields a more livable space and a much better for the family. And I would imagine, compared to brand new construction, that it also is a positive in terms, well, maybe not with brand new construction, but with construction maybe just 15 or 20 years ago. Energy-wise, it has to be much more efficient. Yeah.
The houses today are, so incredibly energy efficient. We've replaced all the windows in our 1935 house And I think the windows perform better than the uninsulated walls of our house. So, certainly there's an opportunity to upgrade the technology.
And I mean, during the 1940s, 1930s, 1950s, there wasn't an emphasis on highly insulating houses. And so,
yeah, and certainly not certainly not in the Seattle area where we had incredibly cheap electricity. I remember moving out here in the 70s, and that the houses I was renting, they all had uninsulated walls and single pane windows. And the owners kind of laughed at me when I asked why aren't you using double pane windows? And I came out here from the East Coast where everybody had upgraded their house to double pane windows. But here in the land of cheap electricity, we lagged behind on that.
So if someone right now is looking to purchase a house and maybe do the remodel to move into it, what's the process they go through? How do they contact you? What do they do once they contact you? What's that whole process like?
So most of my work comes from referrals, either through existing clients or through a network of consultants and contractors I work with. The first contact I have with people is to go see them and see what the existing house is like. It's not unusual, and in the past couple of years I've had quite a few clients that approached me when they were looking. So I would go with them when they were looking at a house and talk about, these are the things that we could do if you bought this house. I generally encourage people to, try and find something that has really a good aspect to it, or good bones, or a combination thereof. So we're not completely pushing over and starting from scratch. And then I go through a questionnaire process. I've got like a 10-page questionnaire I give my clients where they can talk about how they like to live. I don't necessarily need to know all the room sizes or anything like that, but are you a morning person? How do you have how does your family engage at breakfast? Things like that. And that allows us to kind of start with the kind of existing, the initial design phase, which is called schematic design. We go through a very quick series of hand-drawn sketches. I'm still a hand drawer. And we find something that suits their arrangement and, suits the way they want to live. And then from there, I generate exterior elevations and some sections, and we start seeing how the house is going to look. It's a very iterative process. One of the things I like about being a sole practitioner is I get to be involved with the process and with my clients all the way through. I'm not handing it off to an associate. So at this point in my career, I really enjoy that part of it. Enjoy working directly with the clients.
And they really get the very optimal kind of thing, because you're talking not just about the shape of the house, you're talking about the functionality of the house.
Right. What the spaces will feel like, and how this is going to work. And look, you can stand here and see all the way through to the family room. And look, there's a peekaboo view from that bedroom. And so, yeah, that's the fun part.
So I would imagine, too, that by going into a second story, there's some houses which never had a view that now have a view.
That's right. It's, one of the things I noticed when I moved into my house was that we had there was this lovely backyard, and there were just pokey little windows on the back of the house. There was no relationship between the inside and the outside of the house. And certainly, going up a second floor, all of a sudden you discover if if not a territorial view, sometimes you have a peekaboo view of a mountain or some water or downtown.
Awesome. So, Peter, how would somebody get a hold of you to get started with the process?
Well, my email is Peter Greaves, PeterGreaves, one word, .architect@gmail.com. That's the easiest way to get in touch with me.
Okay, say it one more time.
Peter Greaves, .architect@gmail.com.
Perfect. So if you're listening to the program, listeners, do get a hold of him. It really is worthwhile. So thank you, Peter. Appreciate it.
Thank you very much, Mike. Great to talk to you.
We are coming to a commercial break, so don't go away. I want to come back and talk about this other announcement that Wal-Mart made and what's going on. What is happening? Walmart's not the only company that's doing this. What's happening with all these companies? Stay with me. I'll be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So back in the 1800s, there was a bank robber by the name of Willie Sutton. Pretty famous because they asked him, "Why do you rob banks?" And his response was, "Because that's where the money is." And I think about that story when I think about Walmart, and I think about Amazon, and I think about some of the other companies that are now entering into the financial services market. Because Walmart I guess they did announce that they'd recruited 2 senior bankers from Goldman Sachs. Omar Ismail was the key architect of Goldman's consumer lending. So all the consumer lending that Goldman Sachs is doing came through him. The other person they recruited was David Stark, who David Stark put together partnerships with Apple and JetBlue and Amazon for Goldman. So they recruited those 2 people, and they are in the process. Now, last year, the government passed a rule for the FDIC, making it possible for non-financial firms to get a bank charter, just like J.P. Morgan Chase, just like Bank of America, just like Wells Fargo, a national bank charter. And so put that together with who they recruited, add that to a partnership they announced with Ribbit Capital. Ribbit Capital, founded by a Venezuelan guy back in 2012, has set up several so-called fintech companies that are online companies that do banking and do credit. So all of that came together. And at the annual meeting, the CEO of Walmart, Doug McMillan, said, they've got 150 million customers. They've got 5,300 stores, and their customers are asking for affordable financial products. They've got as many branches and customers as Bank of America or Chase or Wells Fargo. And they're looking at the banking side of business. Think about that. They have a tremendous amount of clout. And we know from what they did with the online business, they actually began to compete with Amazon online and develop an online presence, which was really focused on competing directly with Amazon. And now they're moving into this. If you look at just some of the earnings earned by banks make $17 billion annually just from overdraft charges. $17 billion annually. And it's a fairly small portion, or relatively small portion of the people who have bank accounts at those banks that they overdraft. And many of those who overdraft are customers of Wal-Mart as well. So think about what's going on with that Wal-Mart announcement. Amazon already a year ago announced they're getting into the checking business, and they're doing the bank, and they've already got a credit card that's out there. They're moving into this business as well. So when I look at what's going on now and look at the evolution of what's happening in my industry, I see some significant things going on. Now, there'll be pushback against Walmart. It'll be mainly from the banks, but not from the brokerage firms yet. Although a lot of the banks own brokerage firms. We'll see where that goes. But if you look at the evolution, I licensed in June of 1986. Before that, 10 years before that, on May 1st of 1975, prior to May 1st, 1975, commissions were regulated by the U.S. government, by the SEC. If you bought 100 shares of stock and paid X amount for it, that commission was calculated, and that's what you had to pay. You paid a base rate of $6 or $8 plus a percentage of the purchase price of the stock, $6 per 100 or whatever shares. I can't remember the exact formulas, but in 1975, it was a fixed rate you had to pay. Didn't matter whether you went to Merrill or to Shearson or to Kidder or any of the other brokerage firms. Dean Witter, some of those firms who are no longer around. The requirements were the same. The commissions were the same. But in 1975, all that changed. And the brokerage houses didn't expect a lot to change because of that. They continued to charge the same kind of commissions. But there was a guy by the name of Charles Schwab who had a different idea. He thought he could form a discount brokerage, and he did that. In 1975, he had 0 accounts, 0 clients. By 1999, 33% of clients in the market, from small to large, 33%, had at least a discount brokerage. Even some, and a lot of them had a regular brokerage account as well. Very, very significant change. When I got into the business in 1986, the comment was, you don't have to worry about the discount brokers because those are do-it-yourself people. Those are small accounts. They're not going to amount to very much. Now, that was 1986, just 10 years after Schwab had started. TD was just starting up, and they still didn't have a huge part of the market. By 99, 13 years later, they owned a third, or at least a third of the clients had those firms. 1986, when I started out, 95%, maybe more, of brokerage revenues were coming from the big houses. That's 95% of the full service brokers. The average family income in 1986 was $43,000 annually, and I remember coming into the business, $46,000, $43,000. There were brokers, stockbrokers, financial advisors today, and stockbrokers in those days that were making $43,000 or even more than that, and they were being pushed out of the door because they weren't profitable for the firms. Merrill in 1986 or 1987 announced that any account that had less than $30,000 was going to be shuttled off to a call center. They were not going to have a financial advisor or a stockbroker. They were too small. They were too little to worry about or to take time with. I believe now that $30,000 has been moved to $250,000. So that changed, and the RIA model moved up. Today there's a new impact, and that's the robo-advisor is arriving. I had a client once who was a travel agent. I asked him, how do you think the Internet's going to impact your business? He said, I don't think it's going to at all, because it takes a lot of work to make a travel plan. Well, not many exist anymore. But with the robo-advisor, I believe they're entering the field, and it's going to have the same kind of impact on my industry. And those robo-advisors are going to come through places like Wal-Mart and Amazon, and maybe Google and Microsoft. And we're going to see, as Willie Sutton said, why do you rob banks? Because that's where the money is. When you look at where the market is, that's where the money is. We're going to see more people like Walmart make those kind of choices. Just one of many. So anyway, that wraps us up today. Have a very good rest of the weekend. Have a very good coming week. And if it's Saturday, we will be talking about money. Be sure and join me next Saturday as well. We've got so much going on. By the way, if you miss any part of this program or any of the previous programs, you can find them on YouTube. Go ahead and log into YouTube About Money, and you'll find this program and some of the others. You can also find them on our website, adamsfinancialconcepts.com.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial.